Morning came the way it always does. Alarms went off in houses across the country. Coffee brewed in kitchens in Des Moines and Portland and Atlanta. People showered, dressed, and checked their phones. Traffic crawled through the usual intersections. The subway ran on time in New York. Somewhere in Phoenix, an ATM dispensed $40 without hesitation. It was Monday, September 15th, 2008. Nothing looked different yet. By the time most Americans woke up that morning, something fundamental had already broken. Not loudly, not visibly, but definitely. Lehman Brothers, a name most people had never heard, a building most would never see, had filed for bankruptcy in the hours before dawn. 158 years of existence, gone. $600 billion in assets, suddenly worth arguing over in court. But that number doesn't tell you what actually happened. Numbers never do. What happened was simpler and more dangerous than any single bankruptcy. The system hesitated. And hesitation, it turned out, was almost enough. You need to understand something about how money actually moves. Not the money in your pocket, not the paycheck that hits your account every 2 weeks. The other money. The money that banks lend to each other overnight so they can open in the morning. The money that makes sure your debit card works at the gas station. The money that sits between every transaction you make without you ever seeing it. That money doesn't move because of value. It moves because of trust. Banks lend to each other constantly, billions of dollars changing hands every night, not because they love each other, but because they believe the other bank will be there in the morning. It's a system built entirely on confidence, on the assumption that tomorrow will function like today. Lehman Brothers was supposed to be there in the morning. It wasn't. And suddenly nobody knew who else wouldn't be. The markets opened at 9:30 Eastern. Traders sat at their desks watching screens filled with red. Executives in glass offices made calls that went unanswered. In London, where the day was already half over, people were trying to understand what the words Lehman Brothers bankruptcy actually meant for positions they held, for trades they'd made, for money they thought was safe. The Dow dropped more than 500 points in the first hours, but that's not the story. The story is what wasn't happening. Banks stopped lending to each other. Not officially, not with announcements. They just stopped. If you called another bank to arrange a short-term loan, the kind of transaction that happened 10,000 times a day without anyone thinking about it, the answer came back slower than usual. Or it didn't come back at all. Or it came back with new terms, new collateral requirements, new questions about whether your bank had exposure to the poison that killed Lehman. This is what systemic collapse actually looks like. Not fire, not riots, silence. Phones ringing with no answer, questions without replies, hesitation spreading faster than information. Maybe you were working that day. Maybe you were in an office somewhere, or driving a route, or teaching a class, or standing in a warehouse moving boxes from one place to another. Maybe you checked your phone at lunch and saw a headline about Wall Street and thought, that's their problem. It wasn't. The distance between Lehman Brothers and your life was shorter than you knew. Every paycheck your employer sent out required them to have access to short-term credit. Every purchase you made with a card required banks to trust each other enough to process the transaction. Every pension fund, every retirement account, every college savings plan, all of it tied into a web of institutions that suddenly weren't sure who was solvent anymore. You didn't need to work in finance to be exposed. You just needed to exist in the economy. And that morning, the economy was discovering that it didn't know who to trust. Trust is a strange thing to build a civilization on. It's invisible until it's gone. You trust that the ATM will give you money because it always has. You trust that your paycheck will clear because it always does. You trust that the grocery store will take your card because that's how the world works. But all of that trust rests on institutions trusting each other. And on September 15, 2008, that trust evaporated faster than anyone thought possible. Banks that had lent to each other for decades suddenly wanted proof. Proof that you weren't holding the same toxic assets that killed Lehman. Proof that your balance sheet was real. Proof that you'd be there tomorrow. And nobody could give that proof because nobody knew anymore. Lehman looked fine a week ago. Lehman looked fine a day ago, right up until the moment it wasn't fine at all. So if Lehman could hide its problems, or not even hide them, just fail to see them clearly enough, then who else was in the same position? Morgan Stanley? Goldman Sachs? Bank of America? Your bank? The question spread like a virus through the financial system, and the virus was doubt. By midday, the crisis was no longer theoretical. Money market funds, the boring, safe investments that millions of Americans used as slightly better savings accounts, started breaking. One fund, the Reserve Primary Fund, announced it had broken the buck. That meant its value had dropped below $1 per share. That wasn't supposed to be possible. Money market funds were designed to be stable, predictable, boring. But they'd invested in Lehman's debt, and now that debt was worth nothing, which meant the fund was worth less than people had put into it, which meant that even the safest investment wasn't safe. People started pulling money out, not just from that fund, from all of them. A run on money market funds is not the same as a run on banks. There are no lines outside buildings, no people shouting for their deposits. But the mechanism is the same. Everyone tries to get their money out at once because they're afraid everyone else will get there first. And when everyone acts on that fear simultaneously, the fear becomes rational. The thing you're afraid of starts happening because you're afraid of it. If you're watching this outside the United States, you might be thinking, why should I care about an American bank collapsing? Because the architecture wasn't just American. Lehman had operations in 28 countries. It had counterparties, institutions it owed money to or that owed money to it, scattered across every major financial center on Earth. When it filed for bankruptcy, it didn't just vanish from New York. It vanished from London, Tokyo, Hong Kong, Frankfurt. And all those institutions suddenly had positions they couldn't close, trades they couldn't settle, money they couldn't access. The global financial system isn't a collection of separate systems, it's one system, and a failure in one part spreads everywhere. So yes, this is an American story, but it's not only an American story. It's a story about what happens when the infrastructure that holds modern life together stops working for just long enough to make everyone wonder if it will start again. That afternoon, the Federal Reserve held an emergency meeting. Treasury officials, central bankers, regulators, everyone who was supposed to keep the system stable gathered to figure out what to do. They had let Lehman fail. There were reasons for that. Political reasons, moral reasons, practical reasons. They'd spent the weekend trying to arrange a private rescue, getting other banks to buy Lehman, to absorb its losses, to keep it alive. It hadn't worked, so they'd let it go. And now they were watching what letting it go actually meant. The meeting wasn't recorded. No transcript exists, but you can imagine what it felt like in that room. Looking at screens showing markets in free fall, taking calls from banks that needed emergency funding just to open the next day. Realizing that the decision to let one firm fail might take down 10 others. Realizing that too big to fail wasn't a political slogan, it was a description of reality. Here's what most people don't understand about that day. The system didn't collapse. It came so close that the difference doesn't matter in any meaningful sense, but technically it held. Banks kept processing transactions even as they stopped trusting each other. ATMs kept dispensing cash even as money market funds broke. Paychecks still cleared even as the credit markets froze. The machinery kept running, barely, by inertia more than design, but it ran. And that microscopic gap between running and stopped is the only reason the world you woke up to on Tuesday, September 16th looked anything like the world you'd gone to sleep in. Think about your own life for a moment, not abstractly, specifically. Think about where you were in 2008, what you were doing, whether you had savings, debt, a mortgage, a job you felt secure in. Now imagine waking up and finding out that your bank doesn't have your money anymore. Not because they stole it, not because of fraud, just because the institution holding it became insolvent overnight, and your deposits, insured up to a certain amount, sure, but how long does that insurance pay out, are now part of a bankruptcy proceeding. Imagine your paycheck doesn't clear because your employer's bank is refusing to process transactions until it knows whether the bank on the other end is stable. Imagine going to buy groceries and having your card declined, not because you don't have money, but because the network that verifies you have money has stopped verifying anything. That's not a dystopian hypothetical. That's what was possible on September 15, 2008. Not guaranteed, but possible. Close enough to real that people whose job it was to prevent exactly that outcome were sitting in rooms trying to figure out how to keep it from happening in the next 12 hours.
Night fell over New York, over Washington, over every city where someone was still awake, still on the phone, still trying to piece together what came next. The news showed footage of Lehman employees carrying boxes out of the building. That image became iconic. Bankers leaving their office with their belongings, the visual symbol of collapse. But that wasn't the collapse. The collapse was invisible. It was happening in the space between institutions, in the moment of hesitation before a transaction cleared, in the phone call that didn't get returned, in the slow realization that nobody knew who was solvent, who was exposed, who would be next. Markets would open again in the morning, and nobody knew what that opening would look like. The government moved faster over the next few days than it had ever moved before. The Federal Reserve opened lending facilities that had never existed. The Treasury proposed bailouts that made people furious and sick and betrayed. AIG, an insurance giant even bigger than Lehman, got rescued with $85 billion in government money, not because anyone wanted to save AIG, because letting it fail would have taken down the entire system. Because too big to fail wasn't a choice anymore, it was just a fact. And the cost of that fact was going to be paid by people who had nothing to do with creating the problem in the first place. People who worked jobs that had nothing to do with Wall Street. People whose retirement accounts lost half their value in 6 months. People who lost their houses not because they couldn't pay, but because the value disappeared and the bank wanted out. The crisis didn't end on September 15th. It metastasized. It spread into unemployment lines and foreclosure notices and businesses that closed because credit dried up and customers stopped spending. But September 15th was the day the system hesitated, and everything that came after flowed from that hesitation. You're watching this in 2026. Maybe it's late. Maybe you're tired. Maybe you were alive in 2008 and you remember feeling the weight of it. Or maybe you were too young or not yet born, and this is just history to you. Either way, here's what matters. The system survived, but it didn't get fixed. It got patched. The banks that were too big to fail in 2008 are bigger now. The complexity that made it impossible to know who was exposed to what has only increased. The mechanisms that were supposed to prevent this kind of cascade, the regulations, the oversight, the stress tests, exist, yes, but they exist inside the same basic architecture. And that architecture still runs on trust, which means it's still fragile. Not in the same way. The next crisis won't look like Lehman. It will look like something we haven't imagined yet, something that seems stable right up until the moment it isn't. Where are you watching this from? I mean that genuinely. What city, what country, what time of night? Because wherever you are, you're living inside the same system that almost stopped working that day. It doesn't matter if you think about it. It doesn't matter if you work in finance or have never thought about banking in your life. You're in it. We're all in it. And it's still fragile. September 15th, 2008 wasn't the day the world ended. It was the day we learned how close the ending could be, how little distance separates normal from catastrophic, how fast trust disappears, how fragile the machinery really is. Most people went to work that day and came home and had dinner and went to sleep without knowing how close they'd come to waking up in a different world. And maybe that's fine. Maybe we don't need to think about it every day, but we should think about it sometimes. We should remember that the normal we take for granted rests on systems that can hesitate, and hesitation is enough. If this kind of storytelling matters to you, if you find value in this way of looking at the world, in understanding the systems we live inside without the usual noise, then I'd be grateful if you'd subscribe. Not because I need to ask, but because it helps this kind of work continue. And if you can't, that's fine too. Either way, thank you for paying attention, for sitting with this, for letting it be what it is. The markets opened the next morning. They kept opening every morning after that. The system held, but it didn't forget how to hesitate, and neither should we.